Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Caroline Hyde, Taylor Riggs, Katie Greifeld, counting you down to the closing bell, here to help us take Beyond the Bell in the global simulcast. Kriti, Gupta, Paul Sweeney bringing together Bloomberg TV, radio, YouTube. As always, we really try and dissect what has been a change of tack for the market. We started off with risk aversion and managed to push on higher, Kriti.
Yeah, Caroline, what's interesting is what the driving forces actually are, because Paul and I were discussing this on radio just a few minutes ago. If you had gone and looked at the market at 9 a.m. this morning, tech was the underperformer, commodities was the outperformer. To see complete turnaround, to me, at least on the surface, Paul, suggests that this isn't a market that's worried about recession fears on the surface. There's a lot more going on here, specifically perhaps who's actually participating in this market.
Tell you, one of the benefits of being on air pretty much all market day is you get to see how the market evolves throughout the day. And this morning coming in, it was all about the strong dollar. It was all about the weakness of the European currencies, concern about a recession there, concern about a global recession. And now that narrative is kind of turned on its head a little bit, and we've got some of the growthier names really strong today.
I was going to say, Katie could argue with you, Paul, about
Yes.
who was on air earlier. I think she started at 5 a.m.
This
Right.
isn't a competition anyone wants to win.
No more of a
there.
competition. Talk to me, Katie, though, about sort of the lack of volatility that we see, the calmness that pervades within a little bit of the equity market. But bond yields might be telling you a little bit something different when you look at the MOVE index and some of the bond volatility.
Absolutely. I mean, the divergence between bond volatility and equity volatility has been really interesting. We've been talking about that really subdued VIX. Not the case when you look at some of the bond market volatility.
No, certainly not. And we look at that market as we've got 10 seconds until the closing bell, and they start to ring, Blue Apron ringing the closing bell on one particular exchange. And we have some optimism on the S&P 500 at least, just 6 points of optimism as we see these markets settle. We're up 6.2 points. That's basically 0.2% higher on the S&P 500. Notable considering the sell-off had been to the tune of more than a percentage point on the downside. 3,832 is where we end the day's trade. NASDAQ really has been your outperformer throughout the day, 194 points to the upside, 1.75% higher. Meanwhile, the Dow Jones Industrial Average still underwater. Of course, energy stocks really feeling the pain today. We're off by 129 points, 0.4% to the down. The Russell 2000 small caps managing to power on higher from significant sell-offs around 10 a.m. Managed to close out the day more than 0.7% higher.
Yeah, you know, this is fascinating to me because as we talk also about what is moving higher, we got to talk about what the hedge is, what actually works in this market. Paul and I were once again discussing, we've been nerding out a lot on radio, I have to admit, about this commodity story, Katie, simply that was the trade that's been working. It's the macro hedge to go to, but it's also the trade that's most vulnerable to that recession risk. So as we talk about recession, something to keep in mind.
Yeah, that energy trade has been working for a long time. Not so much today. If you take a look at the sector level, what's losing? You have energy way down at the bottom of the pack, and it's been a topsy-turvy day, but this has been the case since about 11 a.m. or so, so something to rely on. You also have utilities leading the losses as well. If you look at what is working, you have media and entertainment stocks leading the broad indexes out of the doldrums. That's Meta, that's Alphabet, some of your social media stocks, also retailers and consumer durables as well, catching a bid, Paul.
Yeah, Katie, as a former TMT analyst myself, I pay attention to those names, and it's nice to see, or it's interesting to see some of those big names that have the big top-line growth stories, like a Facebook, like a Meta, like a PayPal, all outperforming well today. Just goes to show you that investors today were just looking for some good old-fashioned top-line growth.
Yeah, and let's talk about the exact opposite of that trade, which is, of course, the commodities trade. Paul, that was the outperformer this morning. Once again, I'm going to keep hammering this idea because if you actually look on a macro level, commodities are down 9-10% at their lows today, even bigger of a margin than what you saw during the trade war. This is a really big deal when we talk about those growth fears, and it's translating into the stock market by names like ExxonMobil, Halliburton, Freeport-McMoran. That commodities trade, these are all movers that are to the downside, all movers that are weighing the entire S&P 500 down.
Kriti, and I can show that exact reflection. If we go cross-asset for our radio audience, I'm looking at commodities, just a complete vertical of red when you're looking at global macro movers. Brent crude off by more than 9%. Worst trading day for oil in 3 months. We have WTI of more than 8% below that $100 level. $99.69 is where we've been. Interestingly, gasoline have been pulling back from that record high that we've been seeing. But some of the metals, copper at a 19-month low. And interestingly, when we talk about where the haven is, it ain't gold. gold. Gold has been at a 6-month low as well. Why? Because US dollar is really where your haven is. I'm looking at the Bloomberg dollar index. Higher strengthening. We're seeing it up about a percentage point. Therefore, what's weakening against the US dollar? The Canadian dollar, the loonie, obviously, as oil pushes back. We see the Danish kroner. Some of those FX pairs that really highlight what is happening in the commodities market has been lower. But really, euro has been one of the key focuses for the market. When we're seeing it weakening by 1.5 percentage points, we're seeing it $1.03. No wonder the talk about dollar parity is really becoming the narrative, and indeed the worries about the European overall economy. What that means in terms of the face of the recession, that's why we got the bid for havens. Netherlands, their yields down 19 basis points on the 2-year. German debt getting a real bid on as well. Portuguese, Belgium, and indeed the UK gilt market on fire today, Taylor.
You really saw that again here within the U.S. Yields ended lower, but not as low as they were earlier this morning. But I think what's really caught my attention, as you can see there, the 2, the 5, and the 10-year yield are all at about a 282. So it's sort of signaling to you, again, the flatness of that yield curve. You get a little bit of a lift up, a little bit higher going out at 20s and at 30s. You're still only down about 2 to 4 basis points or so on the day, but yields are definitely a little bit higher. So you're still not looking at a full inversion, though that sort of inversion in the recessionary words, Paul, are certainly something that we've been talking a lot about today.
All right, well, Tom Keene is not here, so we can talk a little crypto here. I just want to throw crypto in there because when you talk volatility, you have to talk crypto. Bitcoin up 3.1% right now. Still, remember, it trades all the time, and it's just over $20,300. So a little bit of a lift to crypto today, but it's kind of been trading right or near that 20,000 level for a long time.
You know, it's really funny. I don't know. My whole family is obsessed with crypto. So to come off July 4th weekend just talking about crypto constantly, it's up, it's down, but it's always at 20,000.
Right.
It's really kind of remarkable how it's really established this very firm range at that key level.
But as many would say, once again, this is about, well, the correlations that it still has with the NASDAQ. NASDAQ pushes higher, so too does crypto. And once again, we don't see it as a diversified trade in any way. It does seem to move very much as a risk asset as we speak.
Well, speaking of correlations, Caroline, let's talk about, I think, what the driver is of this particular market, at least year to date. I mean, remember, just about a year ago, we were talking about this correlation between Bitcoin and tech. We were talking about this correlation between rates and tech in particular. And it kind of seems like the correlations, or at least the driver of the domino effect we're seeing in the markets, at least year to date, has been the currency story. What do you do in a stronger dollar environment, even when the dollar gets stronger and stronger, despite yields perhaps coming down like today, Taylor?
And Paul, maybe we punt this to you, because it was Mohamed El-Arian, I think in his Bloomberg opinion piece this morning, talking about some of the silver linings in the market. One of those is that correlations are behaving as they should be. We're also speaking with Diana Amoa here, saying earlier that the way that bonds were not behaving in the first quarter, at least they're starting to finally act like a safe haven once again. And it's a return to those traditional correlations that are giving a sigh of relief here.
Yeah, it's Kriti and I were just talking about the 60-40 portfolio. A lot of people have been writing off the 60-40 portfolio. We're 60% in stocks, 40% in bonds, and that just wasn't working for you this year. But maybe getting a little bit back to normal here as these markets try to discount what's coming up.
My other hot take, other than earnings seasons never ends, it feels like the 60-40 portfolio never will truly die. Certainly, it seems to always come back. And as history shows, it probably will.
Yeah, don't fight against history. Don't fight against the Fed as well at the moment. It would feel we're all waiting with bated breath for those Fed minutes out as soon as tomorrow. The JOLTS numbers as well, the labor data, all of this going to paint the picture of what the reaction function to the Federal Reserve really is going to be.
That payrolls data, I mean, massive emphasis really needed on that, simply as we talk about what the actual, how much really room there is to actually move in this economy. Or is this a lost cause when we're dealing with an extremely tight labor market? Is it recession or nothing, Taylor?
Okay, I did my research. I know last time I was mentioning how many times inflation was mentioned in the earnings calls. According to that same report, recession was now mentioned, Paul, 29 times. That was up from 2 the previous quarter.
Yeah, so I think what we're going to hear this quarter, if we want to just kind of preview a little bit, recession, I think we'll hear that. And I think we're going to hear about the dollar and translations. And the question is, are analysts going to look through those translation effects in the net income, or is that going to be an issue for earnings estimates?
But isn't it better at least that, remember Microsoft, right? At least cutting forecasts due to a strong dollar, but at least it's not something fundamental. Does that give us sort of any reprieve here as you think about the fundamentals of the bottom line?
I feel like companies might actually use the strong dollar as sort of an excuse, maybe if they miss on a few metrics. I know that Microsoft news did raise some eyebrows back a few weeks ago when that broke.
Yeah, Microsoft, Nike, Starbucks, McDonald's, you name it. The list goes on and on. This is perhaps the pros and cons of being an American multinational company in the era of a strong bringback. Well, that does it for our cross-platform coverage of the market close on Bloomberg Television, Radio, and YouTube. We'll be back tomorrow at the same time, same place.